Here's the big difference that I come up with. Maintenance is your general upkeep. So you gotta the yard, plumbing, the work orders. Repairs are usually like, okay, capital improvement events. You know what I mean? Hot water heater. Now, I don't want to spend too much time on this, but understand that capital improvement you can also take under. That's a line item that you can take outside of operating expenses, so it doesn't take away from your net operating income. I don't want to go into that too much, but from a tax standpoint, if you spend money on a water heater or carpet or windows, that's capital improvements. So that'll help you from a tax standpoint, and it won't take away from your value from your net operating income. Here's why, right? So after we got our effective gross income, our operating expenses, the net of that is our net operating income. This is the biggest thing, guys, net operating income. That's the effective gross income minus the operating expenses. That's what's left over to pay your mortgage with, and that's what you're going to pay yourself with. You know what I mean? It's also the value of the property, because an appraiser, anybody looking at the property is going to take that net operating income divided by a market cap rate. I'll talk about that capitalization rate. That's how you come up with a value. Capitalize that income, and that gets you the value, right? And basically, it's what's left after you collect the rents and pay your bills, but before you pay your mortgage. Yeah.
Okay. You talked earlier about appraisal of property. You got two buildings right next to each other.
Yeah.
Same cap rate applied, valuation and stuff like that. They both have the same income.
Right.
One is just gleams.
Right.
And the other one is a dog.
Yeah.
Okay. What's the appraiser doing? I mean, how do they guide?
Well, the way they should do it, they should apply a discount, either discount rate to the cap rate, or use the same cap rate, come up with the value, and then just apply straight discount adjustments to the value. The best way to do it is to use a higher cap rate. So let's just say your building is next door to another building. You've got a great building that's leaving. Your neighbor building is a dog. They should use a 7 cap rate, let's just say, for your building. They should use an 8 cap rate for that one next door. It's a dog that has some issues. So the cap rate should be different. Now, let's just say if they used it as the same cap rate, because if a building has deferred maintenance or has some issues, the way you adjust for that is to use a little bit higher cap rate, so you get a lower value. Some appraisers, though, might use the same cap rate and just take a hard dollar cost of what it would take to fix up the building, take that off of that, of the value. I've seen it done. What you're saying, Eddie, I've seen done differently. I've probably seen it done differently every single time on appraisals that I've seen, because every appraiser, there's standard rules, but then there's also room for that appraiser to make some comments and adjustments.
Do the appraisers of a multifamily apartment complex really go into every single apartment of, let's say, 150 apartments?
Yeah, I got a deal I'm working on. It's 96 units, and the appraiser came through about 50 units. We've had 3 different appraisals on that one.
What's that appraisal cost?
Yeah.
I had 3 appraisals. One cost $2,800, one cost $2,100, and one cost $4,500. So it ain't cheap. It ain't cheap, right?
So it's never going to be, if it's a big apartment complex, all the units are never going to be inspected.
I mean, they say they like to get into all the units, but if they can get into a nice cross section of units, that would be good.
I used to underwrite Fannie apartment loans under their DUS program, and typically Fannie Mae requires 10% of the units. So on a 500 unit apartment, you're looking at 50 units. What we try to do is, when we're going there to the specs, you don't let management take the apartment for you, because they'll take all the You pick
them off the roll.
You've got the rent roll, you've got maybe a site plan. I want to look at a unit here, I want to look at a unit there. I want upstairs, I want downstairs, I want studio, I want 2 bedrooms, I want 1 bedroom.
Right.
A good cross section like Steve's.
Yeah, and it's going to vary, depending, right? But anyway, in the interest of time, I want to get you guys out and kind of blast through the rest of this. And capitalization rate, all right? It took me a couple years to truly understand this, all right? But so if you're struggling with it, let me know. I'll send you this, and there's some other reference points you can use. But I'm trying to make it as simple as I can. Basically, it's the rate of return, the money you get back, the rate of return generated by a real estate investment property based on the net operating income, right, that a property generates. Because remember, the net operating income does not take into account the mortgage payment. So basically, your cap rate is the return you get if you pay cash for a building. Now remember, the main rate of return in real estate that we're talking about is the cash flow, is the net operating income, the income. Not even necessarily taking into account the appreciation or the growth rate. That's a different measurement. When we're talking about the cap rate, we're looking at the income, the yield. And so the cap rate is basically the rate of return you would receive if you paid cash for a building. Let me give you a
Annually or monthly?
Here's a quick example, and I'm using some real vanilla numbers here. Okay, a 10% cap rate would be this example. If I had $1 million and I went out and I paid $1 million cash for a building, if that building generates $100,000 in net operating income, right? So I had $1 million, I paid cash for the building, right? Now, so I got 0 mortgage payment. I have no mortgage. I have bills though. The net that I receive is $100K, right?
What time period?
In a year. Great question, Bill. It's annual. It's always annual. And you look at that from an annual standpoint, right? If you're looking at numbers and you only got 6 months numbers, then all you do is take those 6 months and annualize them out, right? Great question.
So that's my rent I'm getting for the annually the rent.
That's the net. That's your rent minus all the bills you pay.
Right.
That's a great question. That's the net of that.
Right.
You know what I mean?
Right.
Because now that's the dollars you put in your pocket.
Right.
You can't put it in your pocket if you still got to pay the tax man and the
Right.
maintenance man. After you pay all of them, that would be the net. That's what you. If you didn't have a mortgage, that's actually what you put in your pocket.
Net operating income.
And that'd be a 10% cap rate, right? We don't see a lot of those. We're talking about out of state. In Oakland, for the last few years, you've been able to get 9 and 10% cap rates, right? On a case-by-case basis now, you can still get 9, close to 10% if you're in a tougher neighborhood, older building, so on and so forth. The norm for like East Oakland is about 7% cap rate. By the lake downtown, about a 6 cap rate. By the lake, 4.5, 5% cap rate. San Francisco, 3%, right? It's a different world in San Francisco, right? You go to Fresno, Bakersfield, Stockton, you get 9, 10% cap rates. Well, not Bakersfield, but Stockton, Fresno, Sacramento, you can get. Know this, guys. The higher, the better when you buy. It's the inverse for stocks. It means the principle is the same. The higher, the better when you buy. The lower, the better when you sell. Now, you don't control the market cap rate, right? That's the thing we don't control that. What you can control is the income. So let me just say this. Say the cap rate was 10%, right? The way you get to value or price. Now these numbers, cap rate, NOI, and price, they're inversely related. That means if you have 2 of those numbers, you can always figure out the next one, right? So let's just say you can't control the cap rate, but you can control the NOI. Let's say you bought that NOI up to 200 grand, right? Now, still, the market is the same. It's still 10% cap rate. So in order to get to price, all you would do is take the net operating income, 200 grand, divide that by 10%, 0.1. Anybody know what that would be? $2 million, right? So you can't affect the market. You can affect the income, right? Now, and also you can time things right. Let's just say that market cap rate went from 10% to 5%. Let's say your income stayed flat. You didn't perform that well, but the market did, right? Take that same 100 grand now, instead of dividing it by 10%, you divide it by 5%, 0.05. What's that number? That's $2 million, right? But we don't control that number, right? We can try to time it, though. All right, I'm going to blast through this. Other terms, net cash flow, that just simply means the cash remaining after you pay all your expenses and your mortgage. That's the true money. Most of us are going to have a mortgage. That's the true money you're going to put in your pocket. Cash on cash return. This is important. This is the net cash flow, the money you put in your pocket, divided by the total cash invested. That's your down payment plus your closing cost. That's going to give you a percentage. That's your cash on cash return. That's going to let you know if this income property is up to par. So it is based on the income tax, right? Because when you make cash flow, that's income, what you want. And then you may be taxed on that. You're going to be taxed based on your tax rate. So if you're making over 200K, you're going to have a different tax rate than if you're making 50, right? So that's why just basically it's going to be the net cash flow divided by the cash invested. Now, if you have to pay taxes on that, that takes away, because now you got to write a check. But the property, though, that's what the property yield, right? So that's where it gets a little bit more complicated. Good question. Last one, internal rate of return. I'm not going to go to, this is where it gets complicated. This is where you project out for a period of time and you try to look at what the growth rate's going to be. It's the total return, cash flow, tax benefit and or liability, principal pay down. Every time you make a mortgage, unless it's interest only, what's happening? You're paying a little bit towards the principal, right? That means you're gaining equity each time you make a payment. And then if the property grows. So these different methods of return, it's not just one rate of return in real estate. That's why real estate's a really good investment. There's more than one way to make a return. You take all these returns over a period of time and you get a number. And it's basically the total rate of return, the total return on the initial investment on an annual basis once the property is sold. Therefore, you need to have a time period. It's a little bit more difficult to calculate.
It's like a forecast.
It's a forecast. And a lot of institutional investors look at the IRR. That's what the language for it, IRR, internal rate of return. They look at that more so than even the cap rate or the cash on cash. Because they got a lot of money, and they need to look in the future. Sure. Okay, I'm going to blast through these acquisition strategies. I mainly break it down to buying individually and then buying in group syndications. Notes, REO short sales, distressed property. REOs and short sales really diminishing, not so many of them out there. They're still out, but they're on a case-by-case basis. No acquisitions. Here's another thing you guys can do, a lot of people miss. You can buy a loan, a promissory note, at a discount, and either flip that to another investor or foreclose, take over the property. That's a difficult and aggressive strategy. I don't recommend doing it for residential, only for 5+ units and or commercial property. You can also buy a note at a discount simply to get the cash flow, right? Buy and hold, buy and flip, buy, hold, and exchange. That's, I think, the best thing to do. Kind of ending like what you're doing. You got a property you bought, you held it, now you're exchanging it, rolling it up 5 units to 20 units, right? That's a great strategy, right? Without paying taxes. And you're not avoiding the taxes, you're deferring the taxes, right? That's a great strategy.
You're avoiding taxes.
Right. Well, but you don't want to say that. What you do is you legally defer it, and you can defer it till you die, and then pass it to your kids, and they don't have to deal with it. It just rolls over, right? Legally, right? That's important. Contract for deed, lease options, seller financing. These are creative financing methods that are back because people have equity. It was hard to do these deals in the old market because people don't have equity. They can't carry back financing. Well, they can carry back financing now, and you'd be surprised how many people are doing it. That's an old school tactic, and it's back. You are responsible for the financing. That means you have to sign for the loan. You're responsible for the down payment, and you got liability. A tenant may sue you. So those are some of the pitfalls when you buy individually. Also when you buy as a group, but some of the risks we all need to be aware of. Doesn't mean I want to discourage you to buy, but you want to go in eyes wide open, right? The other way to buy a property is to buy it with people, 1 or 2 partners, or go group syndication, right? That's becoming very popular right now because a lot of people have cash, but it's hard to get properties. There's more cash than there's properties right now. If you're out in the market, you probably noticed that. Not a lot of properties available. So people are pooling their money together. When you do that, you spread the risk, the amount of capital needed for the down payment. You can utilize the strengths of each partner. If you have a partner that's really good in construction or really good in management or somebody that's really good with the books, you kind of leverage each person's skills and abilities. This is a plug on the city of Oakland. I'm biased. I'm born and raised here. I have my company here. But the reality is this is the #1 multifamily market in the country right now. #1. In terms of rate of return, overall rate of return, not just cap rate, but overall rate of return that you get because of the price per unit that you buy in relationship to the rent per unit, right? The ratios are really, really good in Oakland. Very low vacancy rate, 2.9%, all right? Reason is, why is that? Because we're quite across the water from San Francisco. A lot of people are coming up here in droves. And they need somewhere to stay. Problem is we don't have so much land, so we can't build and build and build. I was doing deals out in Texas. The problem with certain markets in Texas is while the cash flow may be good, you're struggling with vacancy and your values are going to stay kind of flat because there's so much land. When the markets get good, developers just start building and building. They did in Stockton, in Sacramento too. That old markets, Sac was rolling. The problem is they built too much stuff. Yep. And people were only moving there because it was cheap, not because they were going there for jobs. Right. It was going there because it was cheap. So you got to be careful. In Oakland, even though we got rent control, we got violence, we are the central point of the Bay Area, right across the street from San Francisco. There are jobs here. The weather is pretty amazing, right? The quality of life is not so bad. You know what I mean? Every neighborhood is not BP Soap and Wild West, you know, right? Which is, you know, that surprises a lot of people. Oakland, according to this, I got this article off the National Real Estate Investor, but there's many other publications that are written about the Oakland market, not just multifamily, also single family, time on market, we're number one. Growth year over year, we're number one. So it's a good place to invest if you can find the right deal. So that's the challenge. On that note, okay, I'm gonna present a couple of properties. A 4-bedroom, 2-bathroom house, and then a triplex, all 2-bedroom, 1 bathroom, fully rented. Not too far from Maxwell Park, but it's not the Maxwell Park. This is what you would call, I think, Millsmont. Yeah, I think it is the Millsmont. Millsmont, Eastmont Hills. It's above MacArthur, 1 block, right? So it's bringing in. We got a 7% cap rate on this one, so that's kind of the average, the norm, right? Biggest challenge is my seller is difficult. He's a tough cookie. You know, he's difficult to deal with. We got everything fully occupied, so it's also difficult to show. But the property is a good cash flow property. If somebody came in and put 20% down, also lends itself to somebody. Here's a good strategy. I see a lot of people doing it. Somebody lives in that house, and then they got a triplex in the back, basically paying their mortgage. You know, and all the units are 2-bedroom, 1 bathroom. Okay?
Is the house owner occupied?
Not now, but it can be. Right now, it's this guy owns multiple properties, so he's an investor. But somebody could, because it's residential, get an FHA loan, put 3.5% down, move in that house, rent out the other one, and then 2 to 3 years later, move out of it and rent the house out too. So I see that's very popular right now. So that can be done with this property. This is a property. Now let me just say.
What's the income on that one?
Off the top, I got it at a 7 cap, and we broke that down. I know he's bringing in about 65 to 70 grand a month, roughly. Now let me just say, this deal is technically available, but not for long, because me and Andy are working this deal out. Andy's got an offer. We're working back and forth. I think we're going to work this out, but just to let the group know what we're working on. This is a 20-unit building on 75th Ave, 955 75th at 1.9. It's a projected 7 cap rate. I don't have the actual profit and loss statements. All 2-bedroom, 1 bathroom units, covered parking for the most part. It's gated access. 2 blocks from the Coliseum Park. 1.9 million, although there's some flexibility on that, but just to give a disclosure, me and Andy are working on this deal. I think we're going to get the deal worked out. But it's what, part of our inventory right now.
Oh, Steve,
Yeah.
I was going to tell you on May
Yeah.
that they can go as high as 802 FHA.
Really?
802,000.
802,000. So if you can do FHA, you got a client that can do FHA, that means you're putting a low down payment that's going to increase your rate of return. Also, what we don't have on here,
FHA for 20 units?
well, you can't get FHA for that.
So it
20
has to
units.
be under.
Well, you can get FHA for multifamily.
Yeah.
Now,
It has to be under 500.
for FHA for multifamily, for commercial, it don't make sense unless it's like $1 million. The fees to do it are very
And the minimum is 10% down?
about 15 to 20% down.
Really?
Yeah.
FHA.
FHA for apartment buildings. FHA for residential is 3.5% down. Right. So it's 2 different FHAs. You can't get FHA for an apartment, but you need to be $1 million loan. That's the point. Not the points of fee, but the reports. Like you mentioned, you used to underwrite Fannie Mae, and also they got some pretty hefty reports that they make you pay. So if it's under $1 million loan, it ain't worth it, right? Another thing, we got 3 fourplexes in a row. It's a Brandy Park. They're all 3-bedroom units. 1 is in contract right now. 2 are not listed on the market. The guy, we're in contract for $577, which is about, again, another 7% cap rate. We got 1 offer from an investor. That's a pretty solid offer from the South Bay. Properties does cash flow because they're all 3-bedroom units. Okay, those are off. 1 is in contract. We think the contract's going to fall apart. The other 2 are off market right now. The same owner also owns another fourplex on Fresno Street that we haven't even talked about listing yet, but is out there in off market. So if you guys got buyers or if you want to buy multifamily, let me know. I can get you a copy of this presentation. And these are some of the properties we have in our inventory. And we're always prospecting properties. We're also putting a group syndication together on 96 units. I can't go into the specific details. If you're interested in that, we can talk, sit down, and with that, you have to follow some specific securities laws, so I can't present the deal here at this meeting, but I can say that we're acquiring the building. Very exciting deal. So if you're interested in that, follow me, talk with me, and we can go from there. So with that, you guys, I want to wrap up this meeting. I want to say I'm very, very excited about the multifamily market going forward. Very excited about what's happening in Oakland, and I think now is a great opportunity for all of us to take advantage of this window of time and start building up our wealth portfolio. So with that said, thank you very much, you guys. I appreciate it and have a great evening.